Miller. I am the Managing Director of a United Kingdom company, Alamo Mortgage Holdings. We offer a corporate income bond that pays hundreds of basis points over UK gilts and other government bonds. In this video, I'm going to be talking about how big investors are steering clear of gilts as high UK inflation lingers. So, in recent financial news, big investors are showcasing reluctance when it comes to UK government bonds or gilts, despite some of the highest yields in the developed world. This hesitation is driven by concerns that the UK's persistent inflation problem may lead to even higher borrowing costs. As a result of this reluctance, gilt yields have surged ahead of those in other major bond markets. For example, a 10-year gilt is now yielding 4.4% compared to 3.8% in the US and 2.5% in Germany. Hugh Gember, a markets strategist at JP Morgan Asset Management, suggests that a bigger risk premium is needed for UK government bonds due to the challenging inflation backdrop, labor market conditions, and the Bank of England's predicaments. While U.S. Treasury yields have dropped following a decline in headline inflation, the UK is facing a different scenario. UK headline inflation is expected to be at 8.2%, making investors skeptical of a pullback in gilt yields. Additionally, the UK faces a unique challenge unlike many other countries. UK homeowners often have short-term mortgages that renew every 2 years. This has led to concern that 1 million households could face mortgage payment increases of £500 a month or more by the end of 2026. Christian Kopf, head of fixed income at Union Investment, Germany's largest asset manager, highlights the uncertainty surrounding the Bank of England's response to the mortgage crisis and potential government adjustments to prevent a further rise in the debt-to-GDP ratio. The Bank of England's recent surprise rate hike of 0.5 percentage points to 5% has added to the uncertainty. It has signaled a less predictable monetary path for the UK, raising concerns among investors. Some investors are favoring other big debt markets over the UK due to the unpredictable nature of its monetary policy. Anders Pearson, CIO of Nuveen Asset Management, expresses a neutral stance on gilts, preferring US and European sovereign bond markets where central banks are closer to the end of their rate rising cycle. The reluctance among investors comes at a challenging time for the UK government. It plans to sell £241 billion of gilts this year, a sharp increase from the previous year as debt to GDP ratios rise. The Office of Budget Responsibility has warned of the UK's very risky fiscal position and its vulnerability to debt compared to other advanced economies. While some buyers, including small investors, have sought higher yields, others remain cautious. Greg Peters, CIO of PGIM Fixed Income, believes it's too premature to increase exposure to gilts due to the UK's ongoing inflation concerns. If you're seeking a financial product that offers returns hundreds of basis points higher than UK gilts, it might be time to explore Alamo Mortgage Holdings corporate income bonds. To learn more about our high-yield investment opportunities, please reach out to me, Benjamin Z. Miller, at ben.miller at alamomortgageholdings.co.uk. As the UK grapples with these economic challenges, the gilt market continues to be a topic of concern among investors, emphasizing the importance of carefully navigating this ever-evolving financial landscape. I hope that helps, and I wish you good luck with your investing.